Welcome back to the Milwaukee Market Update. We're covering real estate news and data and breaking it down to help you understand how it impacts your real estate decisions. Teaser, after 1 year of high interest rates, what does the market look like?
What's to take away from this episode? Well, I'm glad you asked, Ty. Interest rates going down, and what is the impact that's going to happen on you? What are we watching on inflation, interest rates, and unemployment? And how will this affect real estate? And also, is a $27 haircut at Great Clips worth it? Ty tells more.
All right, man. Well, let's start off with some quick tips here. Kick us off with the buyers.
Yeah, so a buyer quick tip I'd say is you want to start your process early. The last thing that you want as a buyer is to be starting your home search when your lease is up in a month. That puts your back against the wall. It makes you have to make quick decisions that sometimes when you're thinking from an irrational perspective on a quick timeline, you might take a step back and go, I shouldn't have done that.
Yep.
To me, that sweet spot is around 3 to 5 months.
Yep.
Obviously, the sooner you can start that process, the better. But within 3 to 5 months, first step, always connect with a real estate agent, get pre-approved, understand what your budget is. But that gives you the timeline to be flexible, I would say, where if something pops up that is something you can't turn down, maybe it makes sense to jump on it. But your back hopefully isn't against a wall where it's like, I got to find something this week, and I'm going to take a lot of sacrifices to find something, versus if you give yourself time, you can actually make sure that you're getting into something that makes sense for you.
Yeah, what I love about starting a process early and actually having your search going, so you're watching, these are the areas I'm wanting to live in, you can actually watch for 30, 60 days and see how fast the inventory moves, and we can actually see what the homes close at. So you can actually, instead of like fully relying on your real estate agent to say, is this a good price or am I overpaying? You can see for yourself what other people are paying in before you actually fully enter the market and you start doing your prep work.
When you are seeing the inventory, you're seeing how quick things move, or maybe that you have a week before something moves.
Yep.
It helps you to understand and get in that mindset of how quick do I need to jump when I am ready to make that decision.
Absolutely. Transitioning over to homeowners out there, this is something I actually ran into recently with a client of mine, is make sure you keep a really good log of the invoices and the work that you've had done. The main reason being, one of the processes that we follow when we list your home is you provide a real estate condition report to any prospective buyers, disclosing any defects you know about or maybe any defects that were there that you had fixed. The appraiser, not even the home inspector in today's market right now, is actually looking at that report and doing an extra layer of due diligence to make sure that your lender, who's giving you sometimes the majority of the money that you're using to purchase a home, to make sure they did this work, but was it done professionally? Was it done correctly? You know, an example might be grading of soil around your foundation because maybe you had some prior seepage because you had some negative grade going towards your home. Make sure you document some of that stuff and be ready to go in case the appraiser calls it out for a subject to situation.
Cool. Love it.
Awesome. And let's wrap it up with investors. I know this is something that this is the ever going on battle in the investor space.
Yeah.
Appreciation versus cash flow. Mm-hmm. And here's a tip I have and would love to get your thoughts on, as well as a lot of people come in and say, well, I'd love to get $200 cash flow per door after all my expenses. That's $400 for this property, because that's how I'm going to quit my job. Mm-hmm. And there are a lot of people that are out there selling that dream, gurus, everything else. But don't lose track of the other things that go into a good deal, such as where you're buying, right? Location, location, location. That's what everybody talks about in real estate investing.
Heard that before.
If we took maybe a C area, wherever else, $200,000 duplex here in Milwaukee, which maybe appreciates at 3% per year, versus a $300,000 duplex maybe in a B area that appreciates at 5% per year, even if you were breaking even on that more expensive duplex, or maybe even you're losing a couple dollars, $100 a month on cash flow, if you go up by 5% your value, that gets you to $315,000. If your $200,000 duplex only goes up 3%, that's $206,000. You can see how a few $100 cash flow is not actually going to be the thing that grows your net worth, and in 10 years actually gets you to retirement. Yes, that cash flow is a great short-term goal, so make sure you look at all of the factors of what is my investing timeline? How long do I actually have to let this compound?
Yeah, I think you nailed it too. And also, when you're in a B area versus a C area. And when we speak to that, we just speak specifically on the average price point of that neighborhood. The compounding effect is significant too, because if you start at 300K, that's compounding at, even if it's the same percent increase as a 200 property, it's going to compound, and that is growing on that new increase every year and year. So it's growing faster than something else. I think with any investment, whether you're looking at stocks, Bitcoin, investment, there's always a trade-off that you're going to play no matter what. And real estate investing is no different. It's a trade-off. It's a risk-reward game. And it's incredibly important that you understand what are your short-term goals and your long-term goals. Because I tell every investor I work with that you're never, for the most part, going to retire off of one property. And cash flow is never going to be enough on one property to make you buku rich. Cash flow really is supporting your business. It's keeping your property afloat.
Keeps the lights on.
Keeps the light on. Puts some mailbox money in your pocket. But unless you have 20, 30, 40 doors, it's typically not enough for you to say, wipe my hands, hey, call my boss, time for me just to put my 2 weeks in. But where you do see the significant returns are on that 5, 10, 15-year return from appreciation. And if your property appreciates 100K over 5 years, and then you look at your cash flow numbers over those 5 years, the 100K appreciation is probably going to be more than your total net profits from a cash flow perspective in that same amount of time.
Significantly.
So both are extremely important, and both are just, it's going to depend on what your goals are, if you're in it just for cash flow or if you're in it for appreciation, or both.
Yep, totally agree. Let's dive into our Metro MLS stats. Kind of relating to what we're talking about here with appreciation and everything. So let's just run through some of these quick numbers here, starting with new listings. Probably one of our headlines here for this month. 1,600 homes listed, up 1.5% versus last year. That's 3-month running streak that we have right there in growth and the new listing activity. Pending listings, 400 homes, up 28%. Closed sales, 1,300 homes, flat to a year ago. Another headline that we'll kind of circle back on. Days on market, flat to last year. 21 days versus 22 days a year ago. Still sitting in kind of that 3-week time frame. Then we've got the median sales price, $310,000, up 7% versus a year ago. Very close to what we're seeing on the year, being right around 8%. Average sales price, up 5%. Percent of original list price received, or that percent over asking, is actually now just slightly below 100%. We're seeing people get accepted offers 1% under asking, essentially flat to a year ago, almost no change. Inventory available, or listings out there active right now, 2,800 homes, down 2%. And finally, months of supply, 2.1 months versus what we consider generally to be healthy, right around 4. So that's our quick summary. We've got to talk about it right off the bat. New listings. What are we seeing, man?
Yeah, so these are pretty interesting stats. And I think it's always important that any 1 month snapshot doesn't do a good picture of showing the total trends, because the trend is what's interesting. That's where the data is. And the story of this year has been there's been a lack of new listings. And if we look from November of last year all the way to July of this year, we saw less new listings that month than the same month the prior year. And all of a sudden, August rolls around. We see the first month where we have more listings that month than the last year. And then September, October have been relatively flat compared from this month to a month a year ago. And so we're starting to see now that there's a lot more, from like a trend perspective, we're not seeing a lack of new inventory hitting the market. It's kind of leveling out. It's kind of what I'm seeing here from a new listing perspective.
Which is pretty much about what we expected, because we're getting right when we got to August, as rates were starting to raise a year ago, we are seeing like the actual comparison year over year changes, which makes it easier to achieve better numbers. We are still sitting at about down 20% in terms of new listings versus 2 years ago. Before we had that original decrease. So even though we're seeing a positive impact versus a year ago, it's always good to know kind of what that baseline is and where we're coming from a couple years ago.
The pending sales are pretty interesting to me, though, because we've seen a massive spike now for 2 straight months, comparing this month to last year, the same month, about 27% increase in pending sales September to last September. October, 27% increase in pending sales, same thing.
As soon as you get newness,
and so
snatching it up.
And we look at the history of those going up from last November all the way to almost the same time, June, July this year, pending sales have been relatively flat.
Yep.
And so what I was kind of starting to see here for a couple months was some softening buyer demand, where interest rates have been high. They've been climbing up and up, and we're going to talk about interest rates and what they look like today. But I was kind of getting this feeling that buyer demand is starting to slow down.
Yep.
And all of a sudden now, we're starting to see that these listings are getting snatched up, pending sales are through the roof, and pending sales are a leading indicator of closed sales. So what's pending right now is what's going to close next month. And we saw a massive spike in pending sales in September. Closed sales are flat. They're actually up, though. If we look at September of this year, they were down 20% in closed units.
Yeah.
For October, closed units are flat because we saw a massive spike in pending sales last month. And so
people are getting to the closing table.
Yeah.
And that trend change is the big piece. So our 12-month rolling average is that closed transactions was down 21%. We just massively changed that just in 1 month from we had some new listings, they went pending, and now they closed, now at being flat. That's a 20% change in what the trend that we're seeing, which is interesting to see. And what we always talk about the show is again, what are you going to see in news articles? We literally talked about the news article last month from the Milwaukee Journal-Sentinel saying real estate is down 20% in the Milwaukee market. You think there's going to be an article that's talking about now how it's actually potentially accelerating again?
Yes. Probably not. Probably not. No, but that's not as sexy as a headline.
That's
you know?
right. That's
but
right.
I think, too, one big takeaway from this is inventory from a relative perspective is still low.
Yeah.
We're now starting to see a full year of low inventory, so we can kind of compare what does low inventory now look like compared to low inventory last year. And it's almost like a like-for-like comparison.
I think the best way to compare that is your months of supply, right? Because that's seasonally adjusted. That's just taking what went under contract last month versus what was still left on the market in that given month. We're at 2 months, roughly, of months of supply, the exact same thing as what we had last year. Versus overall this year, we actually saw that months of supply was slightly increasing. Healthy, again, is 4 months. We're currently sitting at 2. Even with these seasonally changes as we go into the holiday timeframe, there's not enough homes available for every buyer that we have out there. This is going to be the best thing that we have to watch on a month-over-month basis to see seasonally, is our inventory climbing faster than it really should? And when that inventory is low, we'll kind of sum it up with everything. What people want to know is, if I buy now, are my home price, is my value, is my appreciation going to come next year? Am I buying at the right time? The median sales price in October grew by 7%. We're now sitting at $310,000 versus $290,000 a year ago. We had this 1 month blip last month at where home prices only went up 3% year over year. Not uncommon to see a little bit of volatility in numbers, but this is the question that we're asking, that everyone's going to be asking as we start thinking about projections for 2024 is, how much will my home's value go up if I buy it today? Use your crystal ball. How much is it going to go up next year? You give me your prediction.
Yeah, I think, to me, that's another indicator, too, of that the buyer demand is still there because prices are still up a year ago compared to where they were. The one thing is percent of list price received, which to me, this is kind of an interesting indicator as well, too. They're basically at minus 0.1% of list prices, what things are going under contract. So the summary is prices are still going up. They're trending up. There's less listings hitting the market relatively to 2 years ago, but from a year-over-year perspective, it's relatively flat, and these homes are going under contract quick. And so it's kind of been a similar story, and it's kind of fascinating to me to see a full year cycle of now less inventory, and we kind of have a year of data to see what that looks like. And it's kind of the same. It's kind of been the same story all year, is that there's less supply, but there's still a healthy amount of demand, and prices continue to tick up here in Milwaukee from a year-over-year basis.
That's where price is going to go. I'm going to hold you down to it. What's your prediction, 2024, and then we'll dive into it in a couple months here once we get more data.
I mean, we're going to talk about some national things that are happening, kind of what's happening with inflation, what's happening with unemployment. I think those, to me, are the two biggest indicators that are going to determine where home prices go, because interest rates are determined from inflation and from unemployment. We've seen inflation start to go down.
So you're saying interest rates are going to be the biggest driver of if we have home price appreciation or not?
I think so.
Yeah.
I really do.
So what's the number?
Yeah.
Don't you want to be the one that gets on the Milwaukee Journal Sentinel because you picked exactly what appreciation is going to be?
I would love to.
Okay.
I don't know if I would or not.
Cool.
Here's what I would say. Like, we don't know if home prices are going to go up or down. We have no idea. I wish I knew, because I probably wouldn't be on this podcast right now if I knew exactly where home prices are going to be. Because I'd be retired.
Yeah.
You know? But it always comes down to your individual situation as a home buyer. If your goals are to own a home, that's all that makes sense, you know? So like, I have no idea where home prices are going to go, but if your goal is to own a home, and if you're planning on living in that home for 5 years, the day to day, the month to month, the year to year price changes should not
It only matters to you and me.
It does, to a sense, you know? If you're planning on owning a home for only a year, maybe it might matter more to you, you know? Because you want to be sure if you own that home and then sell that home a year from now.
Yeah, we should be talking about what we're doing there if we're only owning a home for a year.
But that's the thing. It's like, if you're only going to own a home for a year, does it make sense for you to own a home? I don't know.
Yeah, probably not. But all right, very, very
So
interesting.
I didn't answer your question.
Yeah, you didn't answer my question yet. You kind of
you tell
put it
me
around.
where are home prices going to be next year?
Up 5%.
Okay, all right. I like that answer.
I think that we're going to continue to see positive numbers in new listings. I think we'll see a little bit of improvement in the months of supply. And at the same time, I think that we'll see interest rates stay relatively the same with maybe a slight amount of improvement. Kind of depends on where the unemployment and the interest rates, everything goes. I think we're going to see not as fast as the 3 prior years in 2020 through 2022, but that's specifically here for the Milwaukee market. That's just what I think is most likely to happen.
Tell me about why you think we're going to see more new listings coming up.
I think we're going to see more new listings because we'll talk about the interest rates here in just a little bit, but last year, at this point in the year, we were at 7% interest rates. Today, we're right around 7.5%. So for somebody to want to move, trade, whatever, we're going to have more and more time under our belts where the typical person does stay in their home for, 5, 7, 11 years. It depends on what you look at in terms of average or median. But there's a good portion of the people out there who sell their home in the first 3 years on the market. So year 1, year 2, we're going to start seeing some of those people that have to move because of job relocation, family grows, unfortunately, death, divorce, whatever else, all those things that drive actual real estate decisions, not the numbers, but the why behind home ownership. I think you're going to see people can make those decisions easier when you're going from a 7 to a 7.5, because most home sellers are also home buyers.
Yep.
That's, I think, going to be the biggest driver of us getting a healthier market, meaning months of supply grows.
Yeah, so it kind of sounds like what you're saying is the longer that interest rates stay around where they are, the more listing activity we should see.
I think so, relative to a year prior, which is very low. So we're going to have that low base effect. It's going to feel like inventory is going to be jumping off the shelves.
That is going to be interesting.
And the negative press line next year is going to be inventory climbs to 5-year high. That's what we're going to see, but it's going to be healthy relative to where we were pre-pandemic levels.
Yeah, interesting.
So,
I think it's true, though, too, and I agree with you that like as rates stay where they are, we should see more and more people that are willing to accept, especially if they bought their home close to what rates are now.
Yep.
We're going to have less of that lock-in effect, less of that accidental landlord is, I think, my favorite one, of someone that's like, I'm not going to get rid of this 3% interest rate.
No chance.
And that person probably may never get rid of that 3% interest rate. But the more that we have of homes that have been purchased at a higher interest rate, that pool of homes and of inventory is going to be circulated a lot. Where I think also it might be, we have a giant amount of inventory that's sub 5% interest rates. And I think I've kind of spoke to this on this podcast before, but I'm kind of curious to see, are we just going to see the same like
inventory,
recycled homes that weren't able to get their home under when they purchased it at a sub 5 interest rate? Absolutely.
Well, let's give a quick summary here for our investor followers out there for the duplex space in Milwaukee County. Starting with months of supply or absorption rate, we're sitting at 2.5 months versus 1.5 months a year ago. So definitely an uptick from where we've seen inventory kind of sitting around right now. Median sales price, we're sitting at $200,000 versus $172,000 a year ago. Again, we always see a good amount of volatility on this median sales price. Again, we've gone from 190 to 200 to 180. It sometimes depends on what the actual median list price is that out there, which is up 15% as well. Sometimes that's just the mix of the duplex inventory out there, since this is a much smaller data set. And then the median days on market is 11 days, very fast, exactly the same of what it was a year ago. I do believe for this year, as we've been kind of tracking this, $200,000 for the median sales price, I think is pretty close to the peak of what we've seen So we're continuing to see good value increases for the typical median duplex here in Milwaukee County. Sold listings, 160 duplex listings sold, up 15% to a year ago. Pending last month, down 40. So again, whatever's listed is usually going to be a driving impact of what we can actually get under contract. So we're not seeing as many go under contract. Again, we did have some pretty big portfolios out there a year ago that we're comparing against. New listings flat to a year ago, and active inventory up 3%. So I think the most interesting headline there is we're seeing more listings actually sold in the duplex space. And in general, we're kind of keeping the same trajectory as a year ago. If we don't increase the inventory out there in the duplex space, if we're just to summarize this, we have only about 10% of our inventory out there that's duplexes. And I think the stat you've shared before is historically it's about 20% of families actually live in duplexes.
In Milwaukee.
In Milwaukee County, in the Milwaukee area in general. There's not enough of this inventory out there either, which is why you're seeing a 15% growth in price, median price year over year. And I think the lock-in effect is going to have way longer standing effects in the duplex space where you can keep it, you can have a property manager, you're not impacted by the whys that impact essentially the normal traditional home buyer, home seller space.
Yeah, and I think you can see that too by just the number of sold duplexes in 2023 compared to the same time in 2022 where they're down 33%. Because I think the lock-in effect is even stronger in the duplex space, whereas rates climb. If you're an investor purchasing a duplex, that absolutely hurts your cash flow numbers. And if you're sitting on a 3% mortgage rate, that's great for your cash flow numbers. So I think the lock-in rate is going to have greater effect in the duplex space.
Absolutely. And just to kind of wrap up this investment space, in Milwaukee County, rents for your 2-bedroom, 1-bath house or duplex over the last 12 months came down just a little bit. That's pretty normal for essentially seasonality. We're getting into the leasing time frame where you're having people who have holidays going on and everything else. It's cold. Nobody wants to move.
Yeah.
In terms of the change, it's just a few dollars here. So there's no noticeable changes month over month or for this quarter.
Yeah, I'm going to insert another quick tip right here. I know we already had our quick tip section, but quick tip for investors: do everything you can to have your lease renewal dates align in a warm month. I would say like May to August or September.
Yeah.
That's prime time season for tenants. If your lease renewals are in November, December, January, it's probably going to be harder to fill that unit. The rents aren't going to be as strong.
It's going to be less 5 to 10% lower in the winter than it would be in the summer.
So if you are having to list a unit now, consider maybe doing a 6-month lease or month-to-month 18th-month lease.
Yep.
But long-term, that's really going to help you out if you're able to get that lease renewal in a warm month.
Absolutely. Totally agree.
All right, quick tip over.
Perfect. No more quick tips.
None.
Now let's do some local
0.
anecdotes. What are you seeing out there? So that's what all the stuff we're seeing out there. It seems like a relatively getting healthier market. We know that there's still some competition because the months of supply is staying lower. Prices are going up, so we're still seeing competition out there in the market. What are you seeing for anecdotally?
Yeah, I'm seeing buyers are getting pickier in terms of what they want.
Yep.
I'm seeing a lot less need to have to write these crazy offers. Like I feel like we were having to do earlier this year where we were writing way over ask. We were waiving inspection, but I still do see those properties. If they're in a sought-after neighborhood or a sought-after area, if it's priced correctly or underpriced, you still need to be competitive as a buyer.
Yep.
But I do feel like the ones, I'm also getting the sense of like, there's a lot of inventory, it feels like, that has been sitting for a little bit longer, it feels like, where you're able to write a better offer for yourself as a buyer that protects you more, that's not as crazy over asking. So it really comes down to location. Hot locations are still moving if they're priced correctly.
Yeah. I'm seeing a lot of the same. It's been less of like a percent over asking. I think I shared something similar last month, so no noticeable changes, but like 5K over, 10K over, and usually supported by like other recent sales of like, yeah, we're going to go a little bit over to kind of sweeten the deal because it's maybe a 9 out of 10 home for you. And those inspection not to request amounts, that kind of allowance you're giving to the seller saying, we're not going to nickel and dime you if it's under this dollar amount during your home inspection. I'm seeing that number go down as well. You know, 5,000 was pretty typical. We're seeing anywhere from 2,500 to 5,000 actually working in a lot of situations right now.
Yeah.
So,
and also as we approach the holidays too, there's just like there's less tenants that are looking to move in this like winter time. It seems like there's less people that are looking to purchase in this time too.
For sure.
So, but the stats don't really back that up. I'll say that, but anecdotally, it just feels like there's less people that are like hungry to purchase homes as it's November, as it's Christmas. I've got buyers that I'm working with where like we haven't found anything with them. They're like, yeah, well, I'll see you next spring, you know? So there's a lot of buyers that I think are going to exit in these winter times, which opens up opportunities for other buyers.
Yeah, and to go off of your quick tip earlier of being prepared, it's okay to kind of sit in the waits and knowing that, well, we don't need to leave our holiday plans or something to go see this house. But if we have noticeable changes in the interest rates like we did last week, you know, the week of whatever that was, November, around November 10th last week, the buyers who were ready to go were able to take advantage of 7.5% interest rates versus 8% interest rates versus if you're not actively searching and you're like, oh, wow, now they're under 8%, you're going to be behind the eight ball versus somebody who's been watching the market for 30 days, 60 days, and understands how quickly things can move and seeing the opportunity to get something at a better interest rate.
Yep.
All right, we'll take a quick pause. What other stats are you looking for more information on? Ask us in the comments below. Send us an email as we'd love to give you our take on what's coming next in the Milwaukee real estate market.
Yeah, and if you disagree with us too, let us know.
Yeah, I mean, or if you agree with us.
Or if you agree. If you agree, definitely let us know.
Yeah, bring on the haters.
Yep.
All right, news headlines here in the Milwaukee area.
Yeah.
What do you got, man?
You want me to roll with this? I got two. It's the Deer District. Everyone knows about the Deer District. It's where the Pfizer Forum is. We've seen a ton of investment going into this space, which is cool to see as a resident, what that space looked like when I first moved here 5 years ago to what it is now. We saw an entire development go around Pfizer with the whole Deer District community. We just saw the Yard. What is it? I always get it confused if it's the Trade Hotel or the Yard Hotel.
The Trade Hotel.
Trade Hotel. Thank you. I always call it the Yard Hotel for some reason. The Trade Hotel that just opened up. There's two new developments that are going up in this immediate Deer District area. One of them we kind of missed last month, but Milwaukee is building a new public museum, which if you haven't seen the renderings for this, it looks like something straight out of the future. It is a beautiful building that's going to be right across from the Deer District. And then they also just announced luxury apartments that have been proposed for the Deer District as well.
It's going to be sweet.
It'll be about 200 apartment units, mixed use commercial on the lower. Plan is to break ground on that in 2025. They said they're going to be ultra high end with an average rent of $1,500. Okay. I would like to see
ultra high end at $1,500.
One unit that's at $1,500. I think it's going to be more like a $2,000 a month rent plus.
For sure.
But it's cool to see Milwaukee expand more into that area because it's further away from downtown. And I just like how Milwaukee's progressing in terms of starting to build out these communities that typically have just been vacant lands or underdeveloped for a very long time.
Yeah, I think it'll be interesting as this kind of like a Deer District area kind of connects into Brewers Hill and then into Harambe because there's some long-term vision and plans of connecting the Hop, which is kind of our, extra public transport outside of the bus. Like they have plans to connect, Harambe all the way down to Bayview or to Walker's Point. Yeah. So like as they open up more lines, I could see that actually be pretty interesting in terms of like actually being able to bop around to these different really cool locations for, anybody who's wanted to do maybe an Airbnb and hang out in Brewers Hill and, putts down MLK or 3rd Street and get down into the Deer District area and not have to walk 15 minutes, but be there in 5.
Yeah, I agree. And the Hop's got a long ways to go before it's actually going to anywhere that's like convenient. Yeah. But I do think like the Hop is a great idea.
Phase 1, come on.
Phase 1, yeah. Phase 1 of hopefully many phases.
That's right.
But either way, like I think the crane test is a great example of just to look at a city and see how booming is the city. And Milwaukee passes the crane test, in my opinion. And I feel like every week we're talking about new hotels that are being built, new apartments that are being built, new plans that are proposed to the city of new developments. Yeah. And so it's good to see for the health of the city of Milwaukee overall.
Yep, totally agree. Do you have anything from a national news headlines perspective to dive in next?
Yeah, I got a couple for you, man. So we
hopefully a bunch of softballs.
No, they're softballs, I'd say. So let's talk about mortgage rates.
Okay.
I think it might be helpful, actually, before I dive into these headlines, if you kind of run through the national stats.
Yeah, no
That's
problem.
Okay.
No problemo. So let's start with some of the housing inventory first to start. So, I mean, that's obviously one of the biggest drivers, supply and demand. nationally speaking, we're sitting at about 730,000 homes active for sale at the end of October. This is relative to, back in, pre-pandemic levels. We were sitting closer to 1.2 to 1 million homes available COVID recession timeframe. So still overall low. This is a local show because real estate is so local. So, I mean, this doesn't help you other than the fact that it is low inventory on the national basis still.
And even in Milwaukee, relatively speaking, it's low too.
Yeah, and I would say even more so here in Milwaukee, which is why we're still seeing, as we talk about, the Zillow indexes on the next page, that's why we've been one of the more competitive markets. But first, the biggest indicator of demand that we really have is the mortgage application data, which we're still seeing be at 25-year lows, if not longer, of people actually getting pre-approved to buy a home. We've talked before of, I think there's some data behind the scenes that you just can't track of. Somebody who's been pre-approved 6 months ago is still looking but just hasn't found the right fit. Yeah, it's not a new application, but I think there's a lot of pent-up demand. And some people who are just sitting on the sidelines because of today's interest rates. Yep. Interest rates, I think, would be a huge catalyst of driving more activity in today's market.
Yeah, agreed.
Then going into our Zillow charts that I just love to see, to kind of see what's going on with like the typical home, because we have a lot of these houses that, you sell a $5 million house in the Milwaukee area and that can inflate some numbers for 1 month. Essentially, again, this tracks the 35th to 65th percentile home, your typical home. Milwaukee is still sitting in the top 2 most competitive markets, and home prices going up. Prices going up 8.5% for the typical home in the Milwaukee area. This is where we're really struggling in terms of having availability of inventory. This is the inventory that is trading more frequently because it's people who bought 1, 2, 3 years ago, and then they outgrow their 3-bedroom, 1.5 bath in Cooper Park or in the Milwaukee Tosa French neighborhoods. So that's something we're tracking in addition to the Zillow rent index, where Milwaukee, I think, sits just outside of the top 10 in terms of rents going up year over year for that typical rental. Again, sitting around that kind of middle percentile range. We saw that rent prices in the Milwaukee area going up about 4.8%. So definitely believe that's still over the national average. So you're probably going to be seeing those rent increases over time. Just in general, we're seeing housing prices continue to go up, whether you're renting or if you're buying. You're probably going to see it on either way. And we always come back to, if you want to own your home and that's within your goal set, it usually makes sense to start making that decision sooner rather than later. But also know that technically home prices are outpacing rents, which you might want to try to get in the game and capture that, knowing that your rents could continue to go up relatively quickly.
Why do you think Milwaukee sits so high nationally for both of these measures?
I think I'll start with the easier one, which would be the rent index going up. Milwaukee has one of the best vacancy rates in the entire country, which is essentially around 4.5%, I believe, and I think that's like for investments 5 units and larger. Essentially, they can keep charging more rent because there's actually competition still in the rental market. So those are going up because there's just not, again, Milwaukee's not our sexy market where they're building a bunch of, yes, we're talking about the things they are building that are luxury and increasing housing units. There's just more profit to be had in secondary, primary markets, not a tertiary market like here in Milwaukee.
Yeah.
So I think vacancy rate is a big driver of there is not enough units to go around. And it's very similar, I think, there on the home value side as well going up is we're seeing that months of supply being at 2 months versus 4 to 6 months being healthy. Seasonally adjusted, there's just not enough homes going around for the demand. Supply and demand is always going to go back to explaining the why. There's not enough out there. And honestly, I think there's more pent-up demand, like we just said. If interest rates were not at 7.5% to 8%, I think we'd have even more buyers out there as well. Because we have good migration patterns overall, too, in terms of a younger demographic that's working, family-oriented coming in. And a lot of our older demographic is leaving and moving down to snowbird states and everything else.
Yep, cool.
Yeah. The next thing we have that then we'll kind of roll into our mortgage rates. So inflation. So we're back down to 3.2%, which is actually where we sat back in July of this year. And this was better than the forecast of 3.3. So it's always good when we beat the forecast. That means the markets react well. And we're seeing, because inflation seems to be cooled and seems to be, yes, we had that blip 2 months in a row at 3.7%, but it's come back down again. That allows the Fed to potentially consider or stop signaling that rates have to get increased in the future. That's going to be good for a lot of the home buyers in terms of rates we get. However, that does signal potentially, softness in terms of the economy. Mm-hmm. If we look under the covers of that, 3.2%, core inflation is still at 4%, which is down from a month ago. And then the shelter, the things that's most important to those that probably listen to the show. Give us a guess. I know you're looking at the. I was gonna have you give the guess, and you're just looking at the deck
I got it right
here.
Yeah.
Okay.
6.7%.
6.7%. Nice. Nailed it.
Yeah,
You're perfect. Must be a local market expert. So that's down actually from 7.1. We've been seeing like very negligible decreases in this shelter inflation, just nationally speaking. It's good to start seeing traction there. Do I think we're seeing that here locally in Milwaukee? Probably not, because we're in kind of almost one of those top 10 rents going up markets. But this is a huge piece of core inflation is shelter in terms of like what actually drives this rate. Mm-hmm. So good to see that we're starting to see some improvements there. Now diving into our mortgage rates, we actually saw last week, again, a week ago, we're recording today, November 15th, rates went from like 8.2, 8.25 down to like 7.75, and now they're at 7.45 as of today, November 15th. A very quick change. The biggest driver of that was unemployment, which this impacts like the rates because inflation is cooling down and everything else. This is something we alluded to earlier. Compare that 7.45% to 7.08% a year ago in 2022. We're starting to see apples to apples. People are like, man, for the last 6 to 12 months, I kept on saying, I'll wait for rates to go down. I'll wait for rates to go down. We're seeing that they're about the same, and we're probably going to see more of the same as we go into next year. Mm-hmm. Let's now talk a little bit more about unemployment. What are you seeing out there in terms of like what we're watching is this unemployment rate, and tie that into rates? What are we really watching to advise our clients moving forward?
Well, like this all stems down to that not inflation. Interest rates are not going to change unless there is something that happens to inflation or something that happens to unemployment,
right?
Which sucks because the Fed right now is playing this game where they're trying to have a soft landing, where we could have this perfect trifecta where inflation stops increasing at an absorbent amount, unemployment goes up, but it doesn't crash the economy, and then in that case, interest rates can come down. And it's a very delicate balance, but essentially nothing, in my opinion, interest rate-wise is going to change unless we see a significant spike in unemployment. And they're trying to have something ultimately break, it kind of feels like, which sucks
always
for the
super
day-to-day
weird.
Consumer, you know?
We've been seeing nationally unemployment rate being somewhere around like 3.8 for just months and months. It's been kind of around 3.7, 3.8. And finally, they forecasted that it would finally go up, and it did. So we hit the forecast, which it feels weird because it's bad news, but it becomes good news for like everyone who tries to track the economy. What I think is super interesting, again, because it matters for super local, and this isn't even hyper local down to Milwaukee, but 3.9% is our unemployment rate currently as of October for the nation. Wisconsin is at a 3.1%. That's 80 basis points lower.
Let's go.
Had to throw the basis points out there. So 0.8% lower. We have a strong economy here in Wisconsin. I want to say that Milwaukee is actually pretty dang close to the national. Honestly, there's a lot of room in this to, most of the time, people don't actually even raise yellow flags, red flags until you get closer to 5%. So there's some room to wiggle as we kind of try to go towards that soft landing of keep the economy moving, but having inflation closer to 2% and allowing some of these, the Fed funds rate to essentially come down lower into the 3s, the 4s, instead of the high 4, almost 5.
Mm-hmm. Yeah, well said. And I think like what this all means is like, what's the impact that this is going to have when it comes to buying a home, to the economy, and what's the future of the real estate market from everything we just kind of spoke to. And I've got a couple articles that I want to review with you.
Yeah, let's do them.
So this is one. Wells Fargo warns to brace for 8% mortgage rates that are going to drag the U.S. housing market into a 1980s style recession. And basically this article from Business Insider says that the U.S. market is heading for a recession. Mortgage spiking to nearly 8% would cause home buying to plummet, the bank says. And they compare this to the 1980s when rate hikes were so high it put pressure on the property market. Okay. So that's one side, is
So
that
there's
as
one
rates
perspective.
approach 8%, which they've eclipsed 8% already, that we're going to plummet in terms of just transactions is basically what there says. It's going to put a freeze on the market. No one's going to buy. No one's going to sell. Then we got another article here. This is from The Hill, where UBS Investment Bank says that slowing inflation could enable a 2.75% decrease in interest rates over the course of next year, nearly having the current rate of almost 5.5 to almost nearly 5.5% decline, putting it at 5% interest rates, excuse me. They also predict that the U.S. economy will fall into a recession by the second quarter of next year, which is going to enable the rate cut. Rates will fall as low as 1.25% by 2025. So basically, what a lot of investors, national banks are saying is that we have some early warning signs of a recession. One more article here is saying that there is rising consumer delinquency in terms of their loans based on rising delinquency in credit card, rising delinquencies on auto loans, slight uptick in mortgage. And so we're seeing an increase in those three delinquency rates, which is kind of a indicator of potentially people not being able to pay what they need to pay on time, an indicator that maybe there's tough times ahead. Unemployment is potentially ticking up. So we've got some differentiating things here. One person says that as rates stay at 8%, the housing economy is going to pause and freeze. One person is saying that a recession is going to happen, which is going to lower interest rates. And then we got some warning signs here that maybe there is a recession just based on the average consumer and their delinquency rates on their debt that they have.
Yeah, I think as we kind of boil this down, of some people are saying crash, some people are saying recession, and like that's actually going to maybe improve the affordability and the buying. I think at the end of the day here, that lock-in effect just has such a incredible ripple through, like, even though there's an average consumer, it's also like 2/3 of people live in their home. I think it's like a third pay cash. It's all paid off. 75% have a rate under 4. There's a large percentage of the population that if rates change or whatever it does, or the economy changes, they're not going to be too heavily impacted. And they're really not probably the ones with the credit card debt and the auto loan debt, which are the ones that we're seeing higher delinquency. Probably who's going to get impacted is going to be renters. Is that going to be the bigger risk as we look into the next couple of years? Is it maybe more the investment and the renter market? Will more people have to have more roommates or find cheaper places to rent? Is that luxury real estate market where you're in A grade? Oh, shoot, I can't really afford as much as I used to. I need to go down to a B grade kind of apartment complex. That's where I would see more risk because they haven't locked in long-term debt and housing payments, and they could be higher impacted by credit rates or auto loans or whatever else.
Yeah.
Like, you just have such this like loving blanket of insulation around you from having a home that you bought at least a year ago at lower rates. There's home equity in it. There's home equity lines of credits, which those delinquencies are practically zero. You have such a big backstop, and a lot of these people have assets too. You know, maybe not all of them accessible through a 401k, but if you have a backstop, you're going to use it. Like, I think there's so much behind the scenes of the people who became homeowners the last 3 years. They're protected. I'd be more concerned about the rental markets.
Yeah, that's a good way to think about it too. And I think, like, based on these articles, it's either going to be one or the other. Rates are either going to stay high, and we're going to continue to see basically the same numbers that we've seen. Unless rates go well into the 8s and well into the 9s, we've kind of already seen that there's been a new floor set where rates are above 7%, and we know how that market is. And I think that if rates stay where they are, that market's going to continue as it has for the last 6 months. But if there is some sort of recession, that's kind of what the Fed is hoping to have, is this perfect landing where everything comes together and everyone's happy and dandy. Rates aren't going to stay at 8% if there is a recession. Rates will go down, which will soften up inventory. It's going to have, I think, if there is a recession, though, it's going to lead to some negative effects on the consumer day-to-day, how we operate. There's going to be a lot less, people are going to be a lot tighter with their money. People are going to be potentially risking, like, am I going to have my job next week? So that would, I think, also pause the housing market a bit too, just because there's going to be less people that are going to be buying homes because they want to and more because of that need. But that's kind of how it almost is already, it feels like, you know?
It's probably just going to be one of those things where you have these things that are going to be positive drivers of affordability. like people can afford more house, but at the same time, there's the risk of employment or whatever else, or maybe the unemployment rate goes up. You have the balance that like, I wanted to, but now it's harder for me to get money, or I, unfortunately lost my job, my career, whatever else. Like you're gonna have positive and you're gonna have negative, just like everywhere else. And we're gonna land somewhere in between in the gray area of what's going to be bigger. Is it going to be the affordability being a bigger driver, or is it going to be how hard is that unemployment going to fall?
Yeah.
That's going to be where it's like, and no one will ever know that number until it happens.
Yeah, and that is if that happens too.
Right? Absolutely. All right, so run me through what should we actually like take away from this? Like, I think we're gonna summarize to what we usually do.
Yeah.
If your goals are to buy a home, if your goals are to buy a home, it's super confusing running through this. The market here in the local Milwaukee area seems to be relatively unhealthy in the standpoint of prices continue to go up, not enough inventory, but we do see a future where we get healthier, where there's more options, more things to select, and it's better to do your prep work now and be ready to jump and take a bite out of the market when rates do potentially have a little bit of a correction here and there and be the first one in.
Yeah. I think it's funny because we do this podcast. We do like a deep dive of all the stats and all the numbers and everything. But it's so true that like whatever your personal goals are in homeownership, that's ultimately what should matter. It should make sense for your budget. It should make sense for your lifestyle and what you're after. Obviously, inflation and unemployment are extremely important, are going to have factors in your day-to-day life. But it comes down to, if your goals are, I think you say it best, if your goals are homeownership in the next 5 years, let's put a plan together that makes sense for your budget and your lifestyle to achieve that goal.
Absolutely.
So that's all that comes down to. Like, you want to have a life that you're happy with. If that means you owning a home, I'm not saying that like nothing else matters, but that's ultimately what should matter when you're looking at it. You need to look at it from a lens of what's important to me now in my life and what's going on, and make your decisions from there.
Yeah, I totally agree. And as we look at, potential home sellers out there and you're trying to decide, is now the right time to make my move or whatever else, like this is probably going to be going into a period of the most stability and maybe some of the most predictability we have, because interest rates are similar year over year. When rates are similar, you can plan better.
Yes.
Like that's the biggest thing, is like you can plan like, okay, I can plan around a 7.5%. That feels better than, is it going to be 6.5 or is it going to be 8.5? In 3 months when I get my home listed, sell it, then all of a sudden rates jump on me. That's going to be giving you more predictability. You have this holiday time frame to declutter, enjoy times with friends and family, and then enter the market in February around the Super Bowl when everything kicks off and get ready to go. Yeah, thanks.
That's good.
It's not the first time I've used that before.
Yeah.
And then investors, like, I think it's the tried and true. You got to have that 5-year vision of what you want to do. Cash flow is really tight today because the riskier the loan that you get, the higher those rates are going to be. Cash flow is definitely hard to come by. You need to have that long-term vision and why for why you're actually diving into the investments.
Yes.
What do you have in terms of how some of this stuff actually impacts the investors?
The investor space, I think as rates continue to climb, cash flow gets tighter and tighter and tighter. And those deals that at one point worked 2 years ago no longer work now if you're strictly after cash flow. My advice for anyone is you need to pair your cash flow calculator deal analysis with a long-term projection of your 5 to 10 year mark.
Yep.
People that invest in 401ks.
Yeah.
Are you doing that? Are you looking at your 401k balance every single day? Are you looking at that and thinking, yeah, I'm ready to pull this money out in 2 years? I don't think so.
No, most people
are
aren't.
like, that's their plan until they're 62 and a half.
Mostly because your employer makes it really hard to log into the account. But,
Also that, yeah.
But that's the best way, is like if you could lock away and not ever look at your investment property, it's just like humming along for 5 to 10 years.
Yes.
You'll be happy in 5 to 10 years.
Yeah. And so it's like, that to me is, you got to think of it as an investment, as part of your long-term strategy. And what does that long-term return look like? Bigger Pockets has a phenomenal calculator if you do a buy and hold of showing exactly what your profit is over time if you sold it. And it needs to fit both pictures. It needs to fit the short-term cash flow, but it needs to fit your long-term investment goals.
Yep, I totally agree. Well, what do you have going on? What happened this last month? What's new?
What happened this last month, man? That's a really good question, dude. My weeks are getting pretty busy.
Yeah.
Golf leagues on Mondays.
Okay.
Bowling on Thursdays.
There we go.
Also do another podcast, Formula One podcast.
So you're
which
just
is coming
getting
up
full
in
on ready
Vegas.
for retirement right now.
So
huh? Golfing and bowling.
Golfing and bowling, man. Yeah.
And watching NASCAR.
Yeah, close. Don't ever say those words again. Yeah, so we've just been pretty busy. Heading out to Maryland for Thanksgiving.
Cool.
Girlfriend's family lives out there. Never been to Maryland before.
Sweet.
So excited to put a little pin on. I got a map of all the cities I've ever been to.
Awesome.
And so I've never been to Baltimore, never been to Maryland. So excited to come home and put a little pin on that.
You have to go get yourself a Crush. I think that's the drink of choice, right? You ever had one of those?
No.
Oh, dude, they're good.
Okay.
Yeah.
You've been there before?
Just once, yeah. We're out there, Baltimore area. Yeah.
Nice.
Very, very good stuff.
Yeah. How about you, man?
My very quick one is I got a haircut yesterday. Usually I cut my own hair. But I actually went to Great Clips yesterday.
No.
And it was a great experience.
Good. Okay.
$28, including the tip. It was great.
Yeah.
Not a whole lot of small talk, which is perfect for me.
Yeah.
I just want in, out, 20 minutes, got what I needed done, didn't have to clean up the mess like I usually have to at home.
Yeah.
It was a good investment in my time and everything else.
Well, your hair looks good. It looks very good.
Thank you. I appreciate it. Yeah. Otherwise, we've been bounced for. We had a wedding in Iowa. We had some rugby games recently that our rugby team made it to the Midwest Championship. Didn't pull through and get the win.
Mm-hmm.
But actually getting a little bit of time back onto my calendar now that we don't have Tuesdays, Thursdays, and Saturdays all tied up. But
yeah, you've been a hard man to track down these last couple months.
Yeah. Well, I'm very excited for the holiday time frame as everyone always is to fill the belly with lots of good meals and hang out with friends and families that you don't get to see most of the year. So definitely looking forward to that.
Well, I didn't get an invite to your holidays this year.
Sorry, man. I'd heard that you were going to Maryland. Well, wrapping it up, if you found value in the information we discovered here in the Milwaukee area, please subscribe, hit that bell notification so you know the next time we post the next market update. Thanks, and we'll be back again next month with your Milwaukee real estate market update.
Bye, guys.